The Bank of Canada kept its overnight lending rate at 2.25%. Let's get reaction to this from Theresa Shutt, Chief Investment Officer at Harbourfront Wealth Management. Theresa, thanks as always for joining us.
Thanks, Roger. Great to be here. Yeah, so look, as widely anticipated, the central bank kept its policy rate at 2.25%, following, fairly significant cuts through the last 18 months. After this, 1.6% contraction in the second quarter, the Canadian economy expanded by 2.6% in the third quarter. And that's way above the Bank of Canada's forecast. This is also reinforced by strong employment data, which showed the economy added, over 180,000 new jobs from September to November. Unemployment rate is stabilized at 6.5%. And of course, you've got some other kind of, tailwinds like federal defense spending, improved trade balance, compared to the previous quarter. So, we expect, or, many expect that the Bank of Canada is likely to hold its interest rate steady at 2.25%, actually throughout 2026. There are some kind of current murmurings that maybe there's a hike coming, but I think there's a lot of unknowns, with respect to trade and whatnot. And again, this is really contingent on the economy evolving in line with their projections, and of course, inflation continue to stabilize at 2%. Should conditions change, further rate moves might be warranted, whether up or down. But I think, to Mr. Macklin's point, the economy has proven resilient, and that's kind of that other R word, not recession, and particularly, overall to the effect of the U.S. tariffs. And I think he made this point, despite tariffs between 25% and 50% on some critical sectors, Canada's economy has shown, reasonable signs of strength. It's an economy that's soft, but certainly not a recession. Again, there is some market chatter that the next move could be a hike. But, I think there's a lot that needs to unfold before we see that. So, if that's the case, combined with, Fed cuts that might be anticipated, this could take the policy rate spread narrower, and that would be interesting and could take the Canadian dollar higher. So I think that's also something, that we need to watch. He did, talk about the budget, which I think is important because I think, there's some spending there that's outlined. Generally, I'd say the market gave the budget kind of a B minus, certainly better than the last government. But there's a lot of work to do. There's a lot of good starts. The move to separate operating and capital segments, the move to build out natural resources, infrastructure, while reducing the size of the federal government, they're all positive things. And then on the tariff front, I think he was right. I mean, I think, fully 90% of Canadian exports are protected still by CUSMA, and we're not impacted. While in the U.S., the effective tariff rate has jumped from 17% or to 17% from 2.5%. In Canada, it's just gone from 0 to 5.9%. So there's still this perception that the Canadian public, among the Canadian public, that we've been somewhat tarred and feathered, and that obviously does weigh on business sentiment and consumer sentiment, but it's really not the case. We've also seen, some positive things like, more global investors are putting money into the Canadian economy, and of course the outperformance of the Canadian equity markets. And I think these are all kind of, strengthening signs that, I think this is the right policy decision. But again, there's still some uncertainty going forward. And I think the big one, that I always highlight is really, while we may be satisfied with the policy rate, there's still some issues around productivity.
And what are your concerns with productivity? We'll start there. There's a few other ones that I want to.
Yeah, absolutely. Yeah. So, so I think, while, the economy seems to be, again, resilient, we're not in a recession. The Bank of Canada, in their own words, has said that we are stuck in a vicious cycle of low productivity. And they have pushed for lowering regulatory burdens on companies, increasing competition, to really, improve the company or the country's growth prospects. I think, as I've mentioned before on the show, Canada is very good at nurturing oligopolies, not healthy and strong competition. I mean, you saw the last with the earnings of the banks. They've been highly profitable. There's many reasons for that, but I think part of that is, in many ways, they are a protected industry. So Canada, has really deteriorated with respect to our productivity. And this is something that we need to address. Hopefully through this budget, we can make, some of these improvements. But there's a lot of unknowns. The budget does lean in a lot to capital projects, infrastructure, nuclear, LNG. But and these sectors are meant to Trump-proof the economy. But many are pointing out that for this budget to be executed properly, we need to see coordination between federal, provincial, municipal, Indigenous, environmental, and even private sector partners. And this may take longer than we anticipate. So I think, I think while the economy is proved resilient, obviously, there's a lot to unfold and develop on the tariff side. We can't lose focus on what really impacts our standard of living, which is our productivity.
And with that, if the dollar does strengthen, you mentioned you might be concerned about that. What kind of an impact would that have on productivity and global investment as well?
Absolutely. So, obviously a lower dollar benefits Canada traditionally in markets because it means cheaper exports. But obviously our largest trading partner is implementing tariffs. So it has less of a positive impact on that. But I do think that, a stronger dollar does obviously help the economy, I think, going forward. But, again, and I think the U.S. dollar will continue to be under pressure. There tends to be, there's currently a trend where, foreign buyers of U.S. equities want exposure to AI and tech, but they don't want exposure to the U.S. dollar. And that's potentially because of concerns over, Fed Reserve independence, trade policy, the U.S. administration, and that's going to continue to potentially weigh on the USD. And I think that's something that, will help the Canadian dollar, but there's always pros and cons when it comes to, a stronger dollar for particularly for trade.
And just one last question about, we're talking about the possibility of a rate hike. What do you think might be the trigger for that?
I think if inflation obviously, rears its head again, I think that is, there's a concern. I think that was, expressed by the Bank of Canada. Inflation tends to be pernicious. It is hard to eliminate. It shows up in places that you don't expect. So I think if we see that, then I think, the Bank of Canada, may have to hike. But I think we're kind of far from that. I know that the labor market has stabilized, the unemployment rate 6.5%. That's fairly positive. But I'm doubtful that there's enough pressure in the economy and enough kind of dollars spinning around that we're going to see that type of inflation. But it's something to always keep in mind of because once you start to see it, it's really hard to tap down. And we saw that obviously post-COVID. With all of that money circulating through the economy, we definitely do not want to go there again.
Okay, we're going to have to leave it there, but Theresa, thank you as always for joining us.
My pleasure. Thanks, Roger.
Theresa Shutt is Chief Investment Officer at Harbourfront Wealth Management.